My name is Qhanghe Qiao, and I'm the co-founder of Alpha Protocol. A little bit background about me is I'm a quant. I used to work for hedge funds. I used to work for Susquehanna International Group. And we are the people who develop the strategies and write codes and to execute on the secondary market to make money. So now today I'm going to talk about how blockchain will help improve the efficiency of hedge funds. So what I'm talking, as it was said, blockchain is not just a technology. It's more about philosophy. Mostly I'll talk about from a philosophical view of how we can use blockchain. I'm not going to talk from the top level. I'm just going to go from the bottom level of how, as a worker in hedge funds, and how we can make more money. This is the outline. I'll first go over the hedge fund structure and how they usually operate. And in a big trading firm like Citadel, Two Sigma, what has their team structure and how they do daily maintenance operating. And I will talk about how this blockchain and cryptocurrencies could help in the hedge fund space, and also talk about the advantages, possible problems, who is the correct middleman to get rid of. And I'll talk about the cryptocurrency hedge fund and how we can, make it more regulation friendly, and talk about our product, Alpha Protocol. So when we talk about hedge funds, usually in our minds is a capitalist who often show off his wealth. They hire a group of hardworking, smart people and buy a lot of good computer and get investors' money, and trying to couple all this together to get alpha, to make the excess return, try to beat the market. So hedge fund is actually the structure that combine all this together. So hedge fund itself does not make any money. It's the people who work in there, the developers, the mathematicians. They make all this profit. It's not maybe the capitalists have some branding. They have big names. They can easily raise funds, but they are not the main profit driver. So in the traditional hedge fund, usually they have a GP, they have LP, they have auditors, administrators, and this GP is usually a big trading firms. These big trading firms are usually the hedge funds that we know of, such as Renaissance, Henderson River. So they get 2% of this management fee for whatever, unconditionally, just whether they make money or not, they get this. And you have to try really hard to invest in to get in their list that you can invest. They do not accept everyone's money. So the hedge fund is actually it's a really big industry. It manages over $3 trillion funds, and they have lots of institutional clients, and they are, as it was said, it just connects smart guys to good investors for this. Recently, like in the late 20 or 30 years, there are some quantitative hedge funds that use quantitative models trying to generate profits. And this hedge fund is actually a trust agency that connects the investors who trust this hedge fund could make money for them, who trust this hedge fund could recruit the best people, can best manage their money, and connects with another group of people who are the employees of the hedge fund who will trust this hedge fund to get enough funding to fairly distribute the P&L and trying to get their fair bonus. So usually there are two types of team structure in big hedge funds. Like I'm talking about the hedge funds with like thousands of people. So one type is they have small trading units. They have small teams, like 10, 20 people operating inside of this fund. In this, for these types, a hedge fund is more like a fund of fund. They provide funding, provide payroll service and administration for these small trading teams. These small trading teams generate profits, and the company take a big cut from it. And for the other types, they just separate all these people like a line worker. Some people just work on the collect market data. Some people work on this data trying to generate signal. Some people use this signal, try to develop a strategy and write the code, write the model, and give this model to another person to execute this model. And in the end, no one on this line knows how much money was earned by his work. So they all trust their company to say, hey, I get my fair price. So the profit driver for hedge funds are the quant traders, quant developers, and quant researchers. So they are the people at the bottom level of the hedge funds. They work in a high-level industry, but they are grassroots. So for these structures, these trading firms, they have advantages. It's like they are famous, have good reputation, they can easily raise money, and they can hire top elite people from top universities. And they can have good training structure, education structures, so that everyone come here and immediately use their knowledge to make money. And their disadvantages, like all these big firms. So first, the companies that they take big P&L cuts, and people who really makes the profit doesn't get a fair cut. They are less stimulated, and they are not so much encouraged. And for this role separation issue, that whoever develops the model do not really execute this model. Because whoever develops this strategy should be the one who understands this strategy best. So he should be the one that uses this model and makes the most of this model. And also, these big firms, because they are big, when they hire people, they take more risk. They promise you a very high salary and a high bonus in the beginning, regardless whether you can make money in the end. And when they don't want you, they fire you, and they need to pay the non-compete period. And for employees, they work for this big company. If their performance is good, if they want to move to somewhere else, they cannot, because there's a non-compete. If their performance is not good, they get fired. So they just, something is not quite right here. People are not so comfortable in this space. And also, in these big firms, there are problems like other big firms, that there are teams fighting with each other, and I like this leader, I don't like the other leader in the other department. So I have this perfect strategy, and I give you to execute, why you only make so little money with it. So can I trust you that you are doing the best on behalf of the company, not just doing best on behalf of your own political goal or whatsoever. So finally, there is something called blockchain that come to us, and it's open. That means everyone can join, and both open to all these investors, all these grassroots traders, all these new traders, and it's secure because everything involves money, and we need to ensure that every transaction is secure. And now we can have a very safe, fast, and verification of this key data. So in all this operation of the hedge fund, it's just the transaction of data passing through the levels. And given a cryptocurrency, it's possible for us to motivate this system to perform to function healthily. And we do not need to trust any third person, any third party. So hedge fund is a perfect. It's very suitable for blockchain to be decentralized. It's not like manufacturer like NASA that we cannot decentralize. It's just the people who cooperate with each other. They need a new relationship with each other, a new. A more fair way to split the responsibilities and split the benefits. And the blockchain has done a lot to the financial system, the payment system, and the ICOs has changed the investment banking, has changed the commercial banks, and what it will do to the hedge funds. So the hedge fund is just the organization that organizes people to make the profit. We can actually replace this hedge fund with a blockchain that will just define a standard way that how people should collaborate with each other, how this profit should be separated, and how the risk management should go, and then we can just let it run. So for the small trading teams, the hedge fund as a company as a whole, they provide funding for these teams, and they provide other services, but they take big cuts. So they're taking more than necessary. So the middleman here is the company as a whole, is the whole system. So we are now finding the correct middleman to replace. We are not replacing all these middlemen. So for the hedge fund, this standard thing like accounting, administrating, auditing, they should be replaced. And for these investors, they do not need to wait for the fixed terms. They can easily, they can see the transparent, they can see the whole, maybe necessary transparency of the system, see what is the P&L during the time period that they were investing. And by this way, the management fee could be reduced. And what cannot be replaced are the trading teams, operating teams, and these things are like a secret and the core, something of the core value that will only keep to oneself. And for investors, the investor needs to be able to decide which one I can invest and when I will enter and exit. So, given all these good things for blockchain and this and that will help, that will make the hedge fund startups' lives easier. So in order to start up a hedge fund, you need to have a very good tracking record. You need to have a good team of people. Usually you have, well, I guess everyone who wants to start up a hedge fund will have a good strategy, but they may not have the experience and the time to deal with all these legal issues, the time and the procedural things. And if everything can happen on-chain, all these things, all these costs could be saved, the time, the cost, and the pressure for regulation. So if we have a protocol-based quant trading community, there are some things that can be shared between these startups that, for example, this accredited investor list, their funds, the raw data, and all these contracts, accounting, and they have a clear cross-verified tracking record. And they do not share their models, their strategies, and their detailed positions. And this is different from DAO because we only put the necessary parts and the standard parts on chain and keeps the freedom, keeps the most creative part as the hand of the people. So if the hedge fund only deal with the cryptocurrency, they only trade the cryptocurrency, that's very native for blockchain, and this type of fund has grown very fast, and because cryptocurrency is really become a digital asset, and the space will and the hedge fund for cryptocurrency will grow more because currently, although there are many cryptocurrency and tokens to trade, it's still relatively small compared to the traditional secondary market, and there are many derivatives that were not in exist for this market, such as options, a lot of futures, and all this, and there's no fixed income market, and all this will happen in the future, and this space will grow. And for the crypto funds community, since everything is on-chain, it will be very transparent. So all these transactions there, and everyone can accept the tokens. The token can be converted to other assets, and if we implement good smart contracts, they all have a clear rule to follow. They have to follow this rule, and this process is automatic, and it will enforce the rules to be taken, to be followed. So there are many problems with cryptocurrency funds, but since everything is transparent, it's very easy for the regulators if they want to take action, because they just need to implement a code. They do not need to just take a law. They just say that we implement a chain, and everyone needs to just get on this chain and get funds from here, and they do not even worry about who did money laundering or whatsoever. So we are Alpha protocol. There are some charts, there are some math, and hopefully we can do some real work. So the conclusion is there are some real needs for open, secure protocol for hedge fund space, and the big trading firms could evolve into trading communities, and the small hedge fund startups could reduce their costs and speed up their setup process by joining the trading community. And now that's my talk. Thank you for listening, and now I'm happy to answer questions.
Thank you. Let's see, we have a question here.
Thank you very much. So I have a question. So if I have a smart guys who are looking for investments, is it your Alpha protocol helps them, or you help the hedge funds to manage their assets and make all the blockchain revolution? So what's the short version of your maybe pitch? So how it works?
The short version for Alpha protocol is it creates an asset pool that is like a source of funds, and we'll have all these teams come here and to complete the usage of these funds, and the token holders will view all these teams' information and decide which team they want to invest in, and there we can allocate these assets to different teams, so that it's a democratic process.
Okay, so just smart guys can join your community and
yes.
set their project, and
Yeah.
hedge fund decide and vote, right?
Yes.
It's already the existing platform?
No, not yet.
Okay.
It just started from last month.
When you release, so what's the date?
I think by the end of the year.
Another year. Okay.
Yeah.
We've got another question back here with Larry.
It's a quick question, make sure I understand. So it's basically a hedge fund for crypto asset, right? Not
Yes.
a solution for traditional hedge fund. It's basically
No.
hedge fund investing in crypto asset.
Yes, we cannot touch the traditional hedge funds.
Okay, just make sure.
Okay, another one from John.
Thank you very much. Very interesting. My question is on the risk management part. You had on your list one of the proprietary items is risk management.
Yes.
So I was wondering if with this new platform, how would one assess the risk? Because risk is basically you're analyzing a lot of historical data, historical
Yes.
returns, and
Yes.
a lot of returns for a particular strategy may be applicable to only a certain market condition, like such as
Yes.
you know, a low volatility condition or high volatility.
Yeah.
So how would one assess the risk given that there's lack of historical data to analyze?
Sure, you can see the list that we have put the risk management at the hand of the team, not the not by the blockchain, because we understand that the risk is really strategy dependent and the market dependent. So what we can do is we can only see the net value of the we will have collaboration with the exchange, and exchange will provide their accounts, and with these accounts, the detailed position will not be shared, but only the net value will be shared. So there will be some, for the risk management for the blockchain, we will monitor the net value of the account, so that we know that there are no some of the inside trading or someone try to steal money from the account, such behavior. So in terms of the risk for the strategy or for the whole portfolio, I think I'll put it to the hands of the teams.
Okay, hold on just a second, John.
The traditional hedge fund, part of the infrastructure is, as part of risk management, it's also an attribution of the gains from certain factors.
Yes.
Without, an internal hedge fund structure, how would the investor understand where the excess returns over the benchmark is coming from? That attribution process. Thank you.
Can you repeat this question? I don't quite understand. Rephrase.
So basically the point of hedge fund is that through your strategy, you're trying to employ strategies to earn excess returns over a particular benchmark.
Yeah.
And I think traditional hedge funds would have sort of an attribution analysis, somehow attributing the excess returns from taking a particular risk, like dissecting the risk and saying, my excess return is coming from risk A, B, and C. That's coming from the kind of like the organizational structure of the hedge fund. If you don't have that, if everything is on the blockchain, then how would the investor, how would they understand where the attribution of the excess return would be coming from?
This is a good question that I don't have an answer of, but I'll try to answer. So first of all, we need to define a beta, right, in order to define alpha, and this beta can be of different trading instruments. So Bitcoin and Litecoin may have different beta. So I don't know if it's necessary for user to understand where this alpha comes from, as long as they see the alpha, because now it's a decentralized community and there is no.
Because part of the reason is because the portfolio management is on the investor themselves, right? Because if you have a hedge fund, then you can say, okay, well, I have different traders there, I have different groups, right? And part of investing in a hedge fund is there is some diversification because. I'm investing in the fund, but here that entire role is relegated to the investor themselves. So they kind of have to know what attribution is coming from, so that when they aggregate all of, let's say if I invested in strategy A, B, and C, they have to attribute where the risk is coming from, so they don't over risk in a certain area.
Yeah, since we are trying to build a community, there will be, of course, different teams, and when the investors' money come in, and it will enter a pool that will be shared by these teams. So investors' money, their risk will be, they need to understand the teams that's trading with our protocol, and it's in there. So I'm not sure if there's something that is configurable, and I never saw that question before, and I'll think about that. Okay. Thank you.